Good morning, everybody. It is Thursday, December the 18th. It is just coming on 3 a.m. over there for you guys on the East Coast. So I hope this gets to you prior to the open, since there's only 6.5 hours in order to do it. So I'll keep it quick because I want to go enjoy the sunset over there on the pool deck and enjoy everybody drunk trying to swim because Filipinos can't swim. So I'm going to go have a good time. Futures, here we are. Looking at the zoomed in view of the futures so that you can see we are obviously green across the board. Not over on the Dow. Dow's fractionally flat, down 27 points. We are up 0.5%, up 130 points over on the NQ. We are not yet to that 25,179.50. We are up 0.25% or 15 points right here, almost 0.25% on the ES. We are not yet to that 68.1225. However, it's still early. And over here on the Russell 2000 futures, we are up only, 5 points. So it actually hurt yesterday at the end of the day at the close, seeing some messages that Tony mentioning he took his biggest hit in years. And I know you, NC, we had a one-on-one just a few weeks ago mentioning how you took a hit. Well, I don't know exactly what it was that made you take such huge hits, other than what I believe is not being consistent and trading emotionally. What I mean by that is trading consistency, because you see people making big money because they have been trading for a very, very long time. They've been with me for quite some time. And the position sizing, because it's been 100%, 200%, 500%, 400%, 300%. So then all of a sudden you start thinking, holy shit, this is just too fucking good to be true. And you go in big and you get fucked. Because as I shared here at the very beginning of the month with the December Bulls warning, okay? The December Bulls warning, first and foremost, about that fake print down there on SPY, da-da-da-da-da, but then talking about the comparison, simply the comparison, as we were going into the FOMC of 2018, how it started the year. It started the year correcting just like we did. 2022, we began the year correcting after topping there, right there on the first session of December, coming up there to the FOMC spike, and then coming down here into 4 red weeks into the 2023 launching pad. This isn't the same as 2022. However, it's still December, where we have had a massive rally off of the lows of the year. Same thing in 2025, how we went into the year correcting. Well, 2024 at the end, right over there as we topped on December 6th. Then the FOMC meeting coming after that with the big old move to the downside. Here it is right there. We had 2 red weeks in a row going into Christmas. So it's still there. It's all still there. But like I've shared, you've got to do your analysis. You got to be able to watch. Wednesday, we were looking for upside awareness to be able to short it. Looking for upside awareness to be able to short it. Same thing as I shared over here. When is this? This is the beginning of the week. Am I right? Yeah. This is the triple witching OPEX week. Here, pointing out to you December 2023. That's the target window for the lows. IWM, an 8th green month at 245.57. It's still green. SPY on the edge of glory, 68.13, 6800. It's only been a 103-point month. I've got tick strike going on in the background, so let me turn that off. And here we go. So getting long on a bullish put credit spread and taking a massive hit doesn't make any fucking sense to me whatsoever. You want to go put big money on the line, fucking it's right here in front of you. March 20, IWM 250 puts. They're already above 30%. March 20 Palantir 160 puts. They're not up 30% because I'm not expecting Palantir to get its ass ripped out till the beginning of the year. Apple, March 20, 250 puts. They're not 30%, but they're up 25% yesterday, and they were last week as well on the lows. So here you have 4 red closes in a row. Now, for anybody that took 7 seconds to actually go and set up their own SPX spreadsheet, you can go back and look and see your 4 red closes in a row. Where are your 4 red closes in a row? Where do they happen? What happens? Here you go. 1, 2, 3, 4, 5 red closes in a row in August. And then Jackson Hole. Now, it's not that there's an event. There's always something you can point your finger to and blame as to why something happened. But it's simple common sense. 4 red closes in a row, you're over fucking sold. Same thing over here. 4 red closes in a row going into the end of July, into that massive August 1 sell-off. What happens? You get a big fucking green day the next day. Here, April 7th, the fucking bottom. April 3, April 4, April 7, then April 8th. 4 red closes in a row, and what happens? April 9th, you're up fucking 474 points on the day. So, as for your risk spread, with today being trading session number 16, since you've had a plus 1% day, and there is no law or written rule that says it must comply and provide a plus 1% day, it's simply putting all of the eggs together and trying to make a dozen, where you're looking at it from a common sense point of view and a technical point of view, which is why yesterday taking that risk of that 67, 60, 67, 65, because they just couldn't bounce the day, well, you're in a good position because 67, 88, that's your plus 1% level. Those that got into 67, 25, 67, 20s, you're in an even better position because all you really need is to get a green day plus 3 points, which we've seen happen again. Your new moon is December 20th. Well, you're inside the window right now for that December 20th. So are you possibly placing your low earlier than the Fibonacci spiral, which is targeting 4? Excuse me for having to scroll. No. But we are looking at December 23 and slippage. This has not been dead on accurate. Not as accurate as the February 19th top, but we have seen slippage. So we are inside of the window of where that low could take place, which could be because, again, doing your math, we're now at 183 point range on the month. So quite possible that we have our low for the month. Possible. I'm not saying that the low of the month is in. I'm saying it's possible. And I'm going to give you the bullish point of view as we head into this. Massive 13-point range, massive red day over there on the QQQ. And where are you? You're still holding above 600. Still holding above 600. Where are you? You're only up 16.74% on the month. And the IWM is only up 10.9% on the year. Not on the month, over on the QQQ, on the year. 16.74% on the year. IWM, you're up 10.9% on the year. 2 red closes. You've come down to that very significant, important area, that 245, 246 area. So again, 4 red closes in a row. I could be blind, and I could expect to see a green day today. So I bring you onto the charts, and again, looking at this from just a standard point of view, 5.85% rally, 2.65% dip, broke the 50-day moving average. Well, your 23.6 retracement of that drop takes you back to the 50-day moving average, 67, 63, 63. Your 38 retracement, 38.2, takes you to 67.90. Where's your 20-day moving average, which is roughly just above or just below your edge of glory, which lines right up with your 50 retracement of this drop. So again, we look at it from a bullish perspective as we went into this with a bullish understanding of where we are from a big, broad, wide point of view, that having bottomed there in April, our wave 3 of wave 3 topped over there in October, our wave 4 of wave 3, until it's been broken, has bottomed there back here in November. And where we are supposed to believe that we are is in the final wave 5 of wave 3 of the final primary wave 5 of the big cycle of wave 3. And thus, if you want to play devil's advocate and say this is the one and only way that things are going to work out, then your plus 381.5 point move to the upside over there into that 6904, 6903, and your minus 183 points that you've had here since coming off of the FOMC just after it, your wave 3 is due to project you up to 7101.97, where, as I've shared before, your primary Fibonacci up there is 7121.76. That is what we are supposed to believe. Over on the QQQ, as you can see very cleanly, nice big move, minus 8.83%, a plus 8.35% bounce, and here we have a dip coming right on down to that big 600 warning level. And again, trying to make itself with a comeback, as the AI bubble is well known to have already been busted, but Micron saved you on that. In fact, we'll pull up Micron just here for a minute and look over on the 1 minute chart just to see how it worked out overnight. And there you go. Micron has saved the planet. Come over on to SPY, and again, looking at that fake print, C equals A, 673.80. What is difficult? I don't understand. Rob over there in the UK, I don't understand what is so difficult. You got an ABC, perfect, and now, because it actually worked out almost to the penny, right down to the 123.6 extension, but boom, you bottom there at 670.96, and now your retracements start beginning above the 50-day moving average over there at SPY 675, and then again there at SPY 678.71. I apologize. Hang on a second. Hey! Shut the fuck up. Okay, so we're back. So, again, SPX, big, broader, wider view of things. Looking here at a 4-hour chart. And you can cleanly see, with a naked eye, as blind as you want to be, a big, big buy divergence on your 4-hour. We'll remove that because after having looked here at the SPX, we're going to move to the NDX. And as we move over here to the NDX, which has not only broken the 50-day moving average well in advance, which started last week on Friday, but we've almost come into contact with the 100-day moving average. And again, naked, big, blind eye, and you see yourself a buy divergence on your 4-hour chart. The reason why I mention why these 4-hour charts rather than a 1 minute and a 5-minute chart is because your 1 minute, your 5 minute, your 15 minute, that's what you're trading with when you're scalping. When you're looking for a big move, you're going to your wider time frames, and your wider time frames meaning your 1, 2, 4, maybe even looking at your 6, because understand, with a 4-hour chart, you're not getting a lot of tickers in between. I'm looking here at the 15-minute. This is the 4-hour. Apologize. There you go. There's your 4-hour oversold with your big buy divergence. There's your SPX oversold with your big buy divergence. So again, I had the wrong time frame on there when I started with you, but there you go for your big, broad, wide view to understand the things. Here's your VIX. Like we said, 18, 400-day moving average. How you doing? Came up, made a visit. Now you can get your retracement back down to around 17, 16 on your VIX. Your Dow Jones, nothing has taken place here whatsoever, nothing. You had a tiny little grind to the downside, not even breaking down below 478, nothing, because it's your strongest index out there. And then, again, bring you here to the IWM, plus 12.8% in the matter of a couple of weeks, 2-3 weeks, 12.8%. So to get a little dip here, 4.73, 5%, 5% would take you down here right to the 50-day moving average, right to this big support level that we had here back in the beginning of the month and during Thanksgiving. It's normal. It's absolutely fucking normal. But you don't go betting on upside because, again, put it into just your plain vision, all right? Your plain vision just with your own eyes and open your eyes and look at it. How hard is it for you to pick your fucking refrigerator up and put it above your fucking head? Now, how hard is it if you had your refrigerator above your head to fucking throw it on the floor? One is a lot harder than the other. So when you're looking for that bullish move to the upside, don't stick your fucking head up in your fucking ass if you're doing it short term and you haven't been doing this every single day.